Have you ever felt disappointed because your investments look boring, with slow growth and almost no volatility worth talking about? At the same time, new assets constantly appear promising extreme returns, making it feel like you are missing the next big move. The problem is that financial markets do not only offer opportunities, but also sell excitement, hope, and the illusion of quick gains. Without realizing it, you start opening investment apps not to think about long-term outcomes, but to chase short bursts of attention. This may explain why many people stay active in investing, yet very few actually build long-term wealth through compounding. Ironically, the most successful investors often share portfolios that look extremely stable, quiet, and uneventful over time. In this video, we are not looking for assets that spike quickly, but examining why boring investing often aligns with long-term consistency. Because in many cases, wealth is less about being the smartest in volatility and more about staying calm while others chase noise. There is a reason why investments that feel exciting often carry the highest risk, not because the asset is bad, but because emotions start driving decisions. When prices rise quickly, we feel the pressure of missing out, and when they fall sharply, that feeling turns into panic. This cycle repeats as excitement during gains and fear during losses slowly replace logical decision-making. The market never forces action, but our emotional interpretation of the screen makes it feel urgent. The more often we check prices, the more we feel like we need to respond, even when nothing actually requires action. One of the biggest mistakes is not choosing the wrong asset, but constantly changing a solid plan because the market feels noisy. Large losses often begin with small emotional decisions, especially when confidence makes us believe this time is different. Ironically, markets tend to reward patience more than short-term intelligence, even though patience feels painfully slow. The more exciting your investment feels, the more your attention becomes trapped along with your money. And once your sense of calm disappears, your best decisions tend to disappear with it. There's a psychological tendency called action bias, where we feel the need to act even when doing nothing may carry less risk over time. In everyday life, taking action is usually praised, and people who move quickly are often seen as more effective. But in investing, frequent action often increases exposure to volatility and leads to more costly mistakes. Each price movement feels like a signal to react, even though most of it is just short-term noise within normal volatility. Modern apps amplify this by constantly showing prices, charts, and notifications that pull our attention back in. Without noticing, investing starts to feel like a game driven more by dopamine than long-term thinking. The more often we check our portfolio, the higher the chance of making impulsive decisions during volatility. The best investors often appear inactive because they understand not every fluctuation fits their time horizon. In a system that rewards speed, the ability to not react becomes a rare edge over the long term. That may be why boring investments often mean your money is compounding quietly while your attention moves elsewhere. Many people think investment costs only come from fees or taxes, but the most expensive cost often comes from decisions made when emotions override logic. Imagine two investors holding identical portfolios, but one checks it every few months while the other looks at it multiple times a day. On paper, they own the same assets, but psychologically they are experiencing completely different realities. The investor constantly watching the screen starts seeing small declines as threats, increasing the urge to act even when nothing is required. This pattern repeats during extreme market periods when investors sell in panic and later buy back at higher prices out of fear of missing out. What drains their wealth is not just the price drop, but emotional decisions that push them to buy at peaks and sell at fear. There is a simple reality that is often ignored. A 50% drop requires a 100% gain just to recover. That is why avoiding large losses often matters more than chasing spectacular gains. The market cannot be controlled, but how we react to it is fully within our control, and that is where long-term outcomes begin to form. In the end, the biggest enemy for investors is not volatility, but the decisions made after calmness disappears. If most investors lose money by reacting too often, the alternative is building a system that does not depend on mood. This is where a concept called boredom arbitrage appears, which is about staying consistent while others chase stimulation. The first principle is ignoring noise because not every headline or trend requires action. The second principle is automating good habits so fewer decisions are exposed to emotional mistakes. Many successful investors rely more on systems than on motivation that changes with mood. The third principle is giving time the space to work, because compounding depends on consistency. Before buying an asset, ask if you would still hold it without seeing the price for 5 years. That question often separates investing from speculation driven by the need for constant stimulation. Boredom arbitrage is not about avoiding risk, but avoiding unnecessary decisions driven by action bias. While others chase the next opportunity, you are simply allowing simple decisions to compound over time. There is a reason compound interest is often called powerful, because it grows through small gains left undisturbed over time. Unfortunately, people tend to interrupt that process by trying to fix something that only looks slow. Imagine planting a tree where no one digs it up every week just to check if it is growing. Yet many investors behave similarly with their portfolios by constantly checking and moving things around. They keep shifting money between assets, chasing faster growth that resets the compounding process each time. Investors like Warren Buffett show that most wealth comes from letting investments grow over decades, not constant searching. Stories like this suggest that time often does more work than intelligence in long-term investing. Compound interest does not favor the busiest investor, but the one who stays consistent through changing conditions. Boring investments often support compounding best because they do not invite constant interference. Fewer impulsive decisions allow small gains to build on each other over years, forming visible wealth through patience. Many people quietly make a mistake by mixing investing with entertainment and expecting similar outcomes. We live in a time where every app is designed to hold attention, and markets start to feel like constant stimulation. Enjoying the sensation is not the issue, but using future money to pay for today's adrenaline creates hidden risk. If you want excitement or competition, there are better places than turning your portfolio into a game. Decisions made for excitement often carry invisible costs that slowly erode discipline over time. Long-term investors often follow routines that feel repetitive because consistency supports compounding over time. The world rewards visible busyness, but markets often reward those who can stay still during volatility. The best investments may be the ones you rarely talk about because they do not demand constant attention. Investing works best in the background when it interferes less with your time and mental space. The calmest portfolio often quietly supports a richer life outside the market without drawing attention. We often imagine wealthy people as those who constantly make extraordinary investment decisions, even though wealth is usually built through small repeated actions. Saving regularly, investing automatically, and allowing compounding over time sounds boring, yet these habits tend to outlast shifting trends. The market will always offer new stories to chase, presenting assets framed as the biggest opportunity of the decade. Over time, it is not frequent trading that stands out, but the quiet consistency of sticking to a long-term plan. Wealth rarely comes from spectacular decisions and more often from doing ordinary things with unusual discipline. The boredom arbitrage does not mean ignoring the market, but refusing to let daily emotions control long-term decisions. When you stop chasing every price movement, you begin to notice that life extends far beyond a blinking chart. Money is only one part of life, and if building wealth removes your sense of calm, something in the approach may be off. Truly wealthy investors are not just growing portfolios, but also those who have the mental space to live without constant market stress. Perhaps the most overlooked return is not asset growth, but the gradual increase in calm over time. We are often taught that investing is about chasing the highest returns, when it may actually be about building a system that keeps you calm over decades. Markets will keep shifting and trends will keep changing, while someone else will always seem to be making money faster than you. Comparing your path to someone else's momentum almost never leads to better decisions over a long-term horizon. At the margin, we see money as something that should expand your life rather than quietly take over your attention. Healthy wealth is the kind that quietly frees your time and attention for things that actually matter. The best investment might not be the one that keeps pulling you back into the app every hour. It might be the one that works quietly in the background until you almost forget it is there. What is the most boring asset you own that still gives you a consistent sense of calm over time?